Welcome. We are continuing our lecture series on the conceptual framework for financial reporting. Today's lecture is going to be on the recognition criteria for the elements underlying financial reporting. Just quickly to understand, what does the terminology recognition mean? Well, recognition refers to the inclusion of an item in the financial statements, namely the statement of financial position or the statement of profit and loss and other comprehensive income. Some items are included in the notes but are not recognized on the face of financial statements. Well, that then is therefore not recognition but disclosure. So just to make sure we understand, there are two terminologies that will be used throughout our videos. First of all, recognition, inclusion of an item of PPE, liabilities, whatever, on the face of the financial statements. Disclosure, the item is not recognized on the face of the financial statements, but information about that item is disclosed in the notes. Prime examples are your contingent assets and contingent liabilities. Moving on. Our recognition criteria, before we even consider recognition criteria, we must first have an item meet the definition of one of the elements. So it must either meet the definition of an asset, liability, equity, income, or expenses. Once we have the definition being complied with, then we look at two recognition criteria in terms of the framework. First of all, the probability of future economic benefits, whether it is probable that there will be a future inflow or outflow. Then the second item that must be complied with is this item must have a cost or value that can be measured with reliability. Now, reliability doesn't mean 100% perfection, but we must be able to make some type of reliable estimate at least about the valuation. Great, so recognition criteria, let's just quickly look at the probability. Now, probability has a slightly different meaning for assets as compared to liabilities. Assets probability is a much stricter probability criteria, virtual certainty, and liabilities, well, liabilities need to be more likely than not, 51% probable. Yes, it's not called a pure liability then, often you will then recognize a provision which is in fact a liability. Okay, so the probability criteria must be met. Second of all, the reliable estimate. The reliable estimate, as I said just now, doesn't necessarily need to be a perfect number. So it doesn't need to be an actual invoice. Sometimes, many of the elements that are recognized are based on estimates. You know, the fair value of an item of property, plant, and equipment, well, that is not done with 100% accuracy. Okay? But there must be able to be a reliable estimate made on a valuation model compared to other prices in an active market, etc. So, just to leave you on this note, first, meet the definition of an element. Then, once the recognition criteria are met, the two we've just discussed, then you may recognize an asset or liability. Some of the standards, for instance, on revenue, have additional recognition criteria, as well as standards such as IAS 37 on internally generated assets. There may be additional, more onerous recognition criteria, and those would need to be complied with as well. Recognition criteria tell you when to recognize an asset or liability, not the amount by which you recognize it. There you would have to look to the individual accounting standards. Thank you.